When break-evens tighten, do losses multiply? When break-evens tighten, do losses multiply?
I would think so.
So if your break-evens get smaller because volatility contracts, right? Just think about this for a second. If you have really high volatility, your break-evens are going to be out here because prices are a lot higher, right?
With the same delta short strike, yes.
If volatility contracts like it is now,
but the market's telling you, and the market is moving less per day.
If your break-evens tight like they are now, do losses multiply?
I would think so.
He would think so. And I think he'd be right.
Oh.
Let's go to the next slide. Before 2020, there was never a loss on an early managed 16 delta strangle and SPY that exceeded the initial buying power, including 2008. I'm surprised by that. The worst loss as a percent of initial buying power before 2020 happened in 2009, with the trade's loss at 21 DT closing at 56% of the initial buying power. In 2020, we experienced the first loss that breached buying power by the 21 DT mark, which was 110% of the initial buying power. These are all before 21 DT. That's one of the reasons we've never breached. It's before 21 DT. Let's go to the next slide. Just an important thing to note. In 2025, markets across all asset classes have had wild swings, but we're currently experiencing low volatility. So is this translated to sharp losses on any single trade? Similar to either past sell-offs? Also, when break-evens tighten, do losses multiply? As Tony said, he thinks the answer is yes.
Do.
So we did a study only this year, okay? Only this year. SPY, Qs, TLT, Gold, Microsoft, Apple, NVIDIA, Amazon, Google, all 2025. 16 delta short strangles, managed at 21 days. Computed the magnitude. Okay, despite 2025 being an interesting year to trade for many reasons, the buying power of a naked short premium trade seemed to carry a sizable buffer beyond the worst loss for each asset tested. This year, we have seen worse losses total between 9 and 32% of initial buying power. Surprise?
Yeah, I think so. Yeah.
So the worst loss as a percent of buying power, you can see SPY was 18, Qs was 28, TLT was 9, Gold was 32. That was the highest. And the year-to-date performance of all these, this is as of yesterday. Today we're up a little bit. But SPY up 8, Qs up 10, TLT up 1, and Gold up 30%. I would have thought gold would be more. Let's go. Next slide. So for the top 5 S&P 500 stocks, the worst losses have totaled between 35 and 45, between 30 and 45% of initial buying power. A 70% increase compared to the tested ETFs. So ETFs, relatively harmless. Individual stocks, those are some big ones. However, these stocks also collect 65% more premium as a percentage of buying power than the tested ETFs. So when we look here, the worst loss as a percent of buying power, Microsoft 37, Apple 41, NVIDIA 45, Amazon 30, and Google 33. These are almost high, they're almost all higher than gold was,
Sure,
as being the biggest premium. When you look at these, how these stocks have done this year, you know what's funny about this? A couple things. One,
well, you talked about it. These are all the stocks that are basically, moving the market.
oh yeah,
Right.
this is the market. This is the market.
Right.
What's funny, the only one of all these are down is Apple, down 14% this year.
Right.
Everything else, Microsoft, NVIDIA, I mean, those are crazy.
Google's basically unchanged.
Yeah, Google's unchanged. NVIDIA, Microsoft up over 21 and 28%, and Amazon up 6%. But the numbers here, all higher than all the ETFs by a significant margin.
Yep.
You take significantly more risk, but you make more money. So with the VIX falling, implied volatility is deflating across ETFs and stocks. So the break-evens tighten, the cushions shrink, meaning the SPY, QQQ, and other high premium names like NVIDIA and Amazon now pay less relative to the tail risk. So cut the size, widen the wings, or pivot to define risk iron condors, verticals, or counters to keep collecting premium without the potential to blow out. Okay, this is just a public service announcement.
Sure.
Let's go next slide. just protecting against kind of, volatility expansion. In 2025 so far, the worst losses for short premium trades as a percent of buying power were moderate. The worst loss being gold, GLD, and NVIDIA, where the loss total 32 and 45% respectively of the trade's initial buying power. Now you remember, gold had a 30% move, NVIDIA had a 28% move. And then you were 32 and 45% respectively as were your drawdowns. When implied volatility is high, losses rarely exceeded the trade BPR due to wide break-evens. So as volatility drops, like it is now, break-evens tighten, your buying power cushion disappears, and modest moves can breach your buffer. So you need to reduce size, widen wings, or use defined risk spreads or strategies.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.